method can be a bit difficult to understand at first. So hopefully, to help you out, we're going to do a demonstration problem from the textbook over on page 673. Take a look at exercise 12-16. The company Pfizer is purchasing shares of another company, Carney. They will acquire 25% of the outstanding shares of Carney, which allows them to have significant influence over Carney's operations. Under GAAP, when a company has achieved a significant influence in another company, the equity method must be used to account for this investment. In this case, Pfizer is paying $68 million. They are buying, in essence, a quarter of Carney's net assets at fair value plus future discounted cash flows. That's what goes into the purchase price. So that's $68 million represents their share of the net assets at fair value plus the future earnings of Carney. The equity method recognizes this, and we use it in accounting for the value of the investment account and for equity income for the period. So let's begin by looking at the details of the purchase. At the time of Pfizer's investment, Carney book value of their net assets, their total assets minus their total liabilities, was $192 million. Remember, book value means that the operational assets are being carried at historical cost less accumulated depreciation. When we went and we looked into or did our due diligence, we determined that the true fair value of certain depreciable assets exceeded their book value by $32 million. Furthermore, these assets had a remaining useful life of 8 years. So Pfizer has to take in the difference, well, actually their share of the acquired $32 million in fair value adjustment. And we're going to amortize this over an 8-year period. We're doing this because when Carney determines depreciation expense for their net income, they are going to be using their book value. Pfizer will have to adjust this because they're actually paying for fair value. So we're going to need to make this adjustment because Carney is maintaining their books, rightfully so, using historical cost, where Pfizer needs to adjust this because they're purchasing these assets at fair value. Any amount we pay above our share of the difference between book and fair value is going to be attributed to goodwill. For now, this is important to understand that goodwill is not amortized and will not be part of these equity journal entries. So before we begin our journal entries, let's analyze this acquisition. We prepared this chart, and it is going to allow us to analyze exactly what Pfizer is buying. We're going to begin by looking at the book value of Carney. The problem tells us what the assets are being carried for at book, the net assets of $192. They also tell us there's a $32 million difference between the fair value and the book value. So they don't give us the fair value. Most problems will. So we're simply going to add the book value and then the excess. So the fair value of Carney's net assets are $224 million. Pfizer has not acquired all of it, only 25%. So to determine Pfizer's share of Carney's net assets at fair value, we'll take the fair value and multiply it by the percentage acquired, or 25%. Oops. And that's going to be 56 million. We'll do the same thing for book value. And our share of the excess related to these assets. So we have two things going on, because Pfizer paid more than the book value for their acquisition of Carney shares. We have a fair value adjustment that is going to be needed, and that's going to be for $8 million over an 8-year useful life. And then we have goodwill, and goodwill will be the amount where the cost exceeds the fair value of Carney's assets. So we'll have goodwill recognition of 12 million. The depreciable assets will be amortized over a useful life. Goodwill has an indefinite life subject to impairment. And we'll talk about goodwill impairment in advanced accounting. So let's begin working on our journal entries. The first journal entry will record the purchase by Pfizer of the Carney stock. And this is pretty straightforward. They paid $68 million in cash, so we're going to set up that journal entry. The accounts we used for this purchase will be the same that we would use with any investment. We're going to establish an asset account, investment in Carney. We're going to debit it for $68 million. We're going to reduce cash by $68 million. Next, let's look at the accounting for the dividends that were received. Remember, we have 4 million shares. We're getting $1 per share. So we'll receive a check for $4 million. But this is where we're going to see a difference between the equity method and other methods to account for the investment. When we receive the dividends, obviously we receive cash, so we're going to debit cash for $4 million. The credit, however, is not to a revenue account. We are going to be considering this return of an asset, cash, as a reduction in our investment. In essence, we're trading assets. We're giving up part of our investment in Carney and receiving cash. Why? Again, the equity method treats our share of Carney as if it's part of our business. So by receiving a dividend, just like a dividend reduces retained earnings, the dividend is going to reduce down the investment in Carney. Next, let's look at the effect of net income that Carney reports. Remember, their net income is based on their books and records. Total net income for the period is $40 million. Well, we have, Pfizer has a 25% interest, so 1/4 of that net income will be attributed to Pfizer. So let's take a look at the accounts involved in this. Just like net income increases retained earnings, net income for our investment in Carney will increase the value of the investment account. Dividends reduce the investment, net income increases the investment. Our share of the 40 million, 25% will be 10 million. So we'll increase the asset investment in Carney by 10 million. The other side of that represents some type of income. Our textbook calls it investment income. That gets a bit confusing because investment income typically is dividends and interest. I prefer to use the account equity income. Equity income represents our share of the net income of a company that we must account for under the equity method. Equity income is an income statement account. It will affect Pfizer's net income for the period, and it will be raised by 10 million. The last journal entry will relate to the depreciable assets that we acquired when we purchased our share in Carney. Again, Carney is depreciating their assets based on their book value. Pfizer has to make an adjustment because they are, in effect, purchasing their share of those depreciable assets at fair value. We determined that the total fair value adjustment that needs to be made is $8 million. These assets have an 8-year useful life, so we're going to amortize the $8 million over 8 years, or $1 million per year. This is going to be always used on the straight line basis. The accounts involved will be the same ones that we use for net income. However, because we're making an adjustment to depreciation expense, we're going to be reducing down the amount of equity income that we recognize for the period. So the $1 million will reduce equity income. It will also reduce down the investment in Carney. Let's take our journal entries and post them into two accounts, the investment in Carney and equity income, and determine the ending balance at the end of the year. Our investment in Carney began with a debit of $68 million from the purchase. When we received the dividends, we reduced down the investment by $4 million. When we recognized net income, we increased the investment by 10, and our depreciation adjustment reduces it by 1. So now at the end of the period, our balance is the total of our debits of 78 less our credits of 5, so we'll have an ending balance in the investment in Carney of 73 million. So net income increases the value of the investment. Dividends reduce it. And we have to make any adjustment for the difference between the fair value and book value of depreciable assets. The investment account is a balance sheet account. It is a permanent account. The equity income account is a temporary account. It will be closed out at the end of the year. So prior to closing, equity income would show a credit of 10 million to record the net income, an adjustment of 1 million for the depreciation, and would have a balance prior to closing of 9 million. The equity income would be closed to income summary and then ultimately reflected in the retained earnings. This is the equity method. Again, it is called that because the activity during the year and the investment in the acquired company mirrors what goes on with retained earnings as it relates to a beginning balance, the effect of net income, and the effect of a dividend payment.